Hey everyone, Logan Hertz with Hazeltine LLC. We've got Peter Nelson with us today. Peter, how you doing?
Living the dream, Logan, living the dream.
So today we're doing a little more on that infinite banking hit piece from the Wealthy Accountant. I thought we would take this opportunity to go through some of the comments on his website. And I also wanted to point out I had posted a couple of comments that were kind of addressing some of the misconceptions behind what he had said, and also inviting him, as Chris Kirkpatrick had publicly done, to have a discussion about this with myself and or Chris Kirkpatrick. And my comments were either not approved or they were removed shortly after I posted them. So I think that's important for people to know. So this guy has posted this hit piece, but he is not giving us the opportunity to talk with him about it. Um, so what I wanted to do too is I'm going to click on this contact button before I even get to the comments. And I'm going to do this. Uh, so everyone can see that I've invited him. Hi, Chris Kirkpatrick and myself would like to discuss your infinite banking article in a public forum in order to better educate public. Chris is obviously the author of the video in question in your article, and I am also a proponent of the infinite banking concept, although Chris is not a proponent of infinite banking, merely a proponent of life insurance. Please put some time on my calendar so we can get it scheduled. Okay.
And I have a great moderator actually, because I would probably be considered too biased, but I do know of someone that would be a great moderator for this. So, anyways,
4 times 15 equals 60, right? Okay. So I just want this, so everyone knows, hey, we've attempted to, and this is not the first attempt, by the way. I made a couple of others through the comment section where I was addressing some of the points and also inviting him to have a debate or discussion with me and Chris, and also posting our own video response. And all of those comments were either not approved or removed shortly after they were published. So let's submit that. Okay, so we've invited him. Okay, we'll be in contact with you shortly. Let's see. Let's see if that happens. Okay, now let's go back to here. So we've been through all of this, but I thought maybe we'd go through some of the comments down here and just see if there's anything interesting. I haven't gone through the comments in detail, so maybe there's nothing interesting here. I don't know. Okay. Now, actually, let me go to the last comment because I know I did post something here. So this was one where I actually did post an explanatory reply to this that it seemed like it was published initially and then got removed. So he's removed my comment. So this guy, Sam, I think is actually an agent who works for Chris Kirkpatrick. So Sam actually said something intelligent. Sam says, the cash value is not a separate pot of money. There is a formula for this. Net amount at risk plus cash value minus any outstanding loans equals net death benefit. The cash value is a component of the death benefit. The equity in the policy is not on top of it. It is a part of it. This is literally in the study material to become an agent. It's obvious you don't understand the concept of present value. So instead of available cash value to borrow against while alive, it would perhaps be easy for you to understand if it was labeled present value of your death benefit that you can borrow against. Okay, so that's a pretty decent explanatory comment, I think, right? Kind of addressing the tired old misconception that when you die, the insurance company keeps your cash value, that evil insurance company, right? And his response is, Sam, I fully understand present value. Okay, notice again, his goal is to show that he knows. His goal is not to find the truth, right? His goal is to demonstrate his knowledge and win an argument, right? Kind of reminds me of that fund manager that we were having a discussion, where I was having a discussion with, where his every comment was an attempt to showcase his knowledge and shows that he's the expert and he knows. He's not interested in actually having a discussion where we're both trying to find the truth, right? So he says, I fully understand present value. However, I am forced to discuss the issues with people that are not. So I need to present the information in a way a non-financial person will understand. So you morons are too stupid to understand it. So I got to dumb it down for you.
This is
Right?
Dave. Is this not Dave Ramsey verbatim? You guys are all, you guys are too dumb to own whole life, but I'll own it myself, but you can't own it, right?
Guess what, Peter? I have given presentations to big time senior level executives at major Fortune 500 companies with hundreds of millions of dollars on the line. When we're making those presentations, we are speaking in a way that a non-financial person will understand. Because if a 10-year-old can't understand it, it's not a good idea.
Right.
Yeah, there are some technical details, some technical jargon. Sure, we're building business cases and all that. But at the end of the day, when we're presenting a business strategy to, say, the CEO of Coca-Cola, it's got to be a story that makes sense. Okay. And all the other technical details support that story. But if that story doesn't make sense to a 10-year-old, it doesn't make sense, period. And the simpler, the better. Right. So again, I'm always trying to present all of my stories in a way that a non-financial person will understand, right? Because otherwise your goal is just to obfuscate, right? The goal is to make people think, well, this is just way too complicated. You can't possibly understand this, so you need to have an expert like me do it for you, right? That's not my approach. Is it your approach, Peter?
No, I'm just a simple country boy from East Tennessee. I try to
When
make
you,
it, I try to make it as easy as possible for people to understand.
yeah, because at the end of the day, it is very simple. When you look at all the rich people in the world, you don't see a bunch of Harvard PhDs and nuclear physicists, right? And by the way, when you look at all the people with all the financial degrees, it's interesting to note how few of them are actually wealthy, right? Um, I don't know if you agree with this. I think I've said this before, but I've kind of noticed there seems to be an inverse relationship between the amount of formal financial training that somebody has versus how much they really understand financial concepts, right? When I'm talking to these, senior executives, we're talking about things like cash flow. Never once did we ever talk about return on investment. That was never a metric that came up. It's not a relevant metric, right? And we should view our personal economy the same way that businesses view theirs. It's all about cash flow, right? And other things like that. So, okay. I love your verbiage, present value of your death benefit. It makes it easier for people to understand your beneficiaries do not get the cash value and death benefit. So once again, he's showing he doesn't understand, right? Yes, they do get the cash value and the death benefit because the cash value is part of the death benefit.
Right. I
So
think
they
that's
get,
what, isn't that what Sam just tried to say up above?
yeah, if they get the death benefit, they also get the cash value. So you're once again reiterating your own misunderstanding. You're saying your beneficiaries do not get the cash value and death benefit. Yes, they do. If they get the death benefit, then by definition, they also got the cash value. Those two are not separate. So he's repeating the same mistake and showing he doesn't understand this, right? They only get the death benefit. Once the insurance company gets your money, it is theirs. They have a contractual obligation to borrow a certain amount of funds to you. No, that's he doesn't seem to be very good with the English language. He's probably good with numbers, given that he's an accountant. To borrow a certain amount of funds to you. No, to loan a certain amount of funds to you. You're the one doing the borrowing. The insurance company is the one doing the loaning. So no, they're not borrowing you. That's not correct. They're loaning you a certain amount of funds to you at specific terms. Okay, that's also bad grammar.
But this is till life insurance. That's really
Yeah,
bad.
but this is till life insurance. Yeah, I don't know what that means. Till life expectancy, till you die, till you die. So I guess somehow he's saying that's a bad thing. They're only going to give you money while you're alive, Peter. What a horrible limitation. So after you die, they don't give you any more money. I mean, just terrible. Of course, what he doesn't understand is, but yeah, you know what? If I take out a policy on somebody else and they die, I continue to benefit from that policy because I get the death benefit now, right? If I take out a key man policy on one of my employees and that employee dies, I receive the death benefit, right? So he's again making the assumption that I'm taking out a policy on myself, but I may not. I can take out a policy on other people. And only the death benefit gets paid to beneficiaries minus loans. So again, he's showing again that he clearly doesn't understand this, right? Because his goal is not to understand. His goal is to show that he's the expert, he's the smart guy, and you dumb little rubes can't possibly understand this. So what I replied was I was like, no, actually, there's an important distinction that you're missing. You're saying present value. Now, someone who's an accountant should understand the difference between present value and net present value. Those are two different things. And I'm not going to jump into accounting principles here because unlike this guy, I'm not trying to obfuscate and get into technical details that the audience can't understand in order to impress them with my knowledge and make them think this is super complicated and you can't possibly do what I do and show you should just give your money to me instead. But there is a distinction to be made between net present value and present value that he's missing. And my comment was in part to address that. And my comment was visible at one point and then it got removed. So no, Keith, you clearly don't understand it. It's the net present value, not your present value. There is a difference. And someone who's supposedly an accountant and understands accounting principles maybe should know that. Okay, so again, he's not thinking very precisely, not making distinctions. Okay, so that was I think this was posted like after we had started posting our videos, and so then people who do understand whole life insurance and infinite banking tried to make posts. I wonder if there are others as well who tried to post comments and didn't have their comments published like me. So let's go back up. Most of the other comments I think are from people who follow him and probably don't understand this. So Jonah says, so when proponents of infinite banking talk about keeping your money growing, they are referring to the cash value of the policy, which doesn't even belong to them. They simply are just growing a line of credit that ceases to exist when they die. And then Keith replies, people get real upset. You should say really. That's, again, incorrect grammar. When they discover they only get the death benefit when the loved one dies with whole life, Jonah. Well, they only get upset if it was explained to them in the incorrect manner. Right?
Yeah, that's financial malpractice right there, what he just said.
So talk about keeping your money growing. They're referring to the cash value of the policy. Well, that does grow, right? I mean, just growing a line of credit that ceases to exist. Well, it doesn't cease to exist. It gets paid out in full.
Right. Income
More
tax.
than that to your beneficiaries. So it's not like it goes away and goes poof. No, now all your beneficiaries get more than that, right? Because the death benefit is leveraged. So if you had $500,000 of cash value, you might have had $1 million, $2 million, $3 million death benefit that now gets paid out. I don't see why that's a bad thing.
Right. It's a savings account with a leveraged death benefit, with a leveraged tax-free death benefit. It stuns me that we continue to see that. I mean, it is, once again, it's financial malpractice that these guys continue to twist stuff. It's horrible.
Right. So
Absolutely.
no, the line of credit doesn't cease to exist. It gets paid out in full plus more because the death benefit is always going to be more than the cash value by construction.
And it's not a line of credit. I mean, you can
Right.
kind of like it, but it's not.
Right.
It's
Right. You could think of it as a growing line of credit, the way Don Graves refers to a reverse mortgage. But it's much more than that, obviously. Credit implies that you're taking on debt when you use it. No, you're not. Okay.
and by the way, when it says which doesn't even belong to them, yes, the cash value, if you have a policy for 20 years and there's a cash value in there, there's going to be a thing that says surrender value. If you really want all that cash, you can surrender the policy. That's your cash. So to say that right there, I know he's asking in a question, but no, that is wrong. That is your
Yeah.
cash. Now, in order, Logan, I mean, if you're going to access it via a loan, you're borrowing money from the insurance company, but that's the advantage of a loan. You can access it income tax free, right?
Yeah, and now your line of credit, your cash value keeps earning for you. Yeah. That's a good point, Peter, because they keep saying that, oh no, the cash value is not yours. Well, effectively it is yours. To your point, if we really wanted that cash, we could surrender, we don't even have to surrender the whole policy. We could do a partial surrender, right?
Right.
And now it is my money. The reason why we don't do that is because that would interrupt the earning potential of all that cash value. So it's usually better to borrow against the policy, right? So borrowing against the policy, we do it because it's superior to just withdrawing our money. But we could.
Right. But
And again, as compared to what, right? Benton Penn always likes to ask, hey, Peter, what's the cash surrender value of your IRA,
right.
right? You have $1 million in an IRA. Well, do you? If you want to just cash out your chips and go home, how much money can you actually get? Maybe half that after taxes,
600,
fees,
well,
penalties.
let's just say 600,000, just roughly.
Plus, by the way, because I've done this before, I've cashed out a retirement account. They do not make it easy for you. If you want to get your money out of Wall Street's white knuckle grip, they're going to fight you tooth and nail. It took
Yeah.
me weeks to get my what's supposedly my money, but it's not, right?
Right. I mean, right now I have a client, they're I'm not going to mention them, but let's just say one of the top three largest Wall Street firms, because I also do business with them, but they're holding it up because of I can't stand medallion signature guarantees.
Oh
The
yeah,
the
yeah,
only reason, let me just say, the only
yeah,
reason for a medallion signature guarantee is because they want to hold on, they want to try to lock up your money longer.
yep,
It's absolute ridiculousness that any company
right.
does that. And this firm does it, by the way, on only $100,000. It's horrible.
I've run into that same problem, not with a retirement account, but yeah. And again, they act like, oh, it's to protect the consumer from fraud to make sure it's actually you. No, it's not. It's a way to make it as difficult as possible for them to get their own money, what supposedly their own money, out of your white knuckled grip. You know,
Yeah. So if
that's
you got
what.
$1 million of cash value in a life in a with a life insurance company, and you actually needed that all that money right up front, and you weren't going to loan it, you were just going to surrender the policy. What, 5 to 7 days, that money can be direct deposited right into your account. Let me say that again. 5 to 7 days. I mean, we could even probably get it sooner. I'm just saying normal
Mhm.
from a normal mutual company or whatever. They'll direct deposit right into your account.
Yep.
That
Yep.
easy. By the way, we could be in the middle of a financial crisis. 2007, 8, when all the banks are failing, our companies, they're like, $1 million? That's nothing. That's chump change. 10 million? Hey, they got it. They're fully liquid. That's why these big mutuals and our fraternal insurance companies, they don't get bailed out because they don't need to. They don't need FDIC. The reason why they have FDIC is because banks fail all the time.
Mhm. 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 Yep. You have contractually guaranteed rights over your cash value. So it is yours in a way that no other financial asset is yours. Absolutely.
By the way, if I don't know if you saw, it was interesting. The first Bank of the Year just failed up by where I grew up in Philadelphia. And then a bank that I know quite well, Fulton Bank out of Lancaster County, Pennsylvania, just bought the assets. But I just thought that was while we're talking, I just mentioned FDIC. Um,
Yep. Have any mutual life insurance companies failed, Peter?
nope, not that I know of.
Nope. Have they ever not, the ones we work with, have they ever not paid a dividend?
Not that I know of. Even during the Great Depression, Great Recession, all that. And by the way,
Over 100 years straight.
this bank that just failed, I was just reading the article. I think it's going to end up costing FDIC $600 million. And you know, it's interesting. Bank of America just reported bad results. Bank of America just had to pay FDIC $700 million to shore up FDIC. So pretty much all the money that Bank of America just paid FDIC just went out the door to go bail out this bank that failed in Pennsylvania. And this is a small bank. You know, we couldn't cover one major bank. We couldn't cover it. And yet we think there's trillions of dollars sitting in these banks. I'm not saying they're gonna fail. Gosh, I hope they don't. It would be really bad, but diversifying some of your money outside of these banks, I think it's, especially in these uncertain times, is really, really important. And I've talked about the Bank of Lebanon, the country of Lebanon, right, before. So, you can go back and watch another video about that. But yeah,
Yep. Yep.
not to go on too much of a rant, but it was on my mind.
All right, let's go to the next one. This is gold. I ran across the infinite banking concept a while back and didn't spend the time to determine why it didn't quite sit right with me, but it certainly wasn't making sense to my accountant mind. Appreciate you clearly laying things out. Well, okay, is what it is, I don't know where he ran across it, but it's possible he ran across someone who didn't explain it very well, which plenty of people don't explain it very well, but okay, whatever. I appreciate the article as it helps to understand the concept better. The only thing I didn't see addressed is the tax sheltered growth as promoted by the IBS, I think he meant to say IBC concept. It seems to me a Roth would
Wait,
be a better
wait.
route.
Yeah.
Right. It seems to me a Roth would be a better route invested in index funds.
Isn't
Well, no, if you
IBS
put
like
your,
irritable bowel syndrome or something?
yeah, yeah. So I would say there's so many things wrong with comparing a Roth to IBC. First of all, his assumption is, oh, well, you'll get a better return on your index funds. Well, prove it. Prove that you're going to get a better return in index funds. No, you're taking on market risk. You're limited in what you could put into the Roth, and you're incredibly restricted in the use of it, right? So if you put your money in a Roth, you're locking it up in jail. If you put your money in whole life, you're not locking it up in jail. You have access to the money anytime you want. It's fully liquid, right? So no, putting it in a Roth is giving it to Wall Street so they can lock it up in their jail and keep it forever. And
And
there
by
may
the
be
way,
some,
I don't know if everybody realizes when a Roth IRA was created in 1998, named after Senator William Roth, and they literally copied the benefits of cash value life insurance when designing it, because they both do something very similar. They grow tax deferred, you can access them income tax free, and it'll go to the beneficiaries income tax free as well. So the only difference, really, in a way, yes, you're right. The Roth will lock it up in the Wall Street, but a Roth really has an investment option, whereas traditional cash value life insurance does not have those investment options. Of course, we know there is variable life insurance policies. You can put sub accounts and all that stuff in. Not to say we're big proponents of that, but anyways, I just wanted to mention that.
okay. Jeff, I had to decide where I would make the cut on the info dump. Yes, there are taxes. So once again, yeah, I had to decide where I'd make the cut on the info dump. So again, you people are too stupid to understand it. So I got to simplify it for you. Yes, there are tax advantages to the cash value life insurance policy. That doesn't affect the internal rate of return. Here we go again. The internal rate of return. Again, when someone starts talking about rate of return, you can stop listening because they don't know what they're talking about, right? It's all about cash flow. It's not about rate of return. That metric never comes up when you're trying to manage a business. It never comes up when you're managing your personal economy. It is an advertising metric in order to manipulate you into locking your money up in Wall Street's vehicles so they can supposedly grow it by advertising some rate of return. Okay. But that's always predicated on you giving up your control, your capital to somebody else where you have no control over the outcome, right? I can't control the S&P 500. Neither can you. And how much income is it giving me? How much is it paying me in the interim, right? So the internal rate of return is irrelevant, okay? But of course, if you wanted to make a true apples to apples comparison, the internal rate of return on whole life is amazing because of all the other benefits it gives you. So if you truly normalize for all the benefits that whole life insurance is giving you when you're comparing it to some investment account, what you find is that the rate of return you would have to get in that investment account to truly match what whole life insurance gives you is something on the order of 17%. 17%. Because what he's looking at is just the internal rate of return on the cash value, which ignores so many of the other benefits. Okay. So the actual true real life rate of return you're getting is closer to 17%, or the rate of return you would need to get in some other account to match the benefits that the whole life insurance policy is giving you. Okay. But does affect the after-tax rate of return on outside investments. I did touch it a bit when I mentioned Treasury Direct is state income tax exempt. The real truth, the math would have gotten messy and the post longer if I started breaking out the details. I think people do understand my concept, however. Okay. So once again, comparing it to an investment, right? Oldest trick in the book, right? And by the way, a Roth and all those others, those are not real investments. Those are speculations because a real investment pays you, right? When you start a business, when you invest in real estate, you are receiving income from that investment. If you're not receiving any income, it's not an investment. It's speculating. And it's okay to speculate, but don't confuse that with saving and don't confuse that with investing. Okay. I've been pitched whole life as a way to shelter income from ordinary income tax on private money lending that I do. It has never sat well with me. Do you have any quick tips on lending private money in a tax-efficient manner outside of a retirement account? I'm currently doing it through an LLC tax as a partnership. Okay, so this is kind of a technical question. I don't want to go too deep into private money lending. It's kind of a
Yeah,
distraction, but you
yeah.
can, so you can, if you want, this is a more advanced use case, but you can use policy loans from your life insurance company to do hard money lending. That does give you positive arbitrage. There are tax advantages to it. I know guys who use whole life insurance for private money lending. It can be a great use case, but I don't know. I don't think it would behoove us to go into that on this episode.
But look at the answer here, Logan.
So he says whole life does shelter income from taxes as long as the policy doesn't lapse. Well, I don't know what you mean by income. It doesn't shelter your income from taxes. Maybe in this context it does. Again, he's being very imprecise with his verbiage. He's being so sloppy. If you make ordinary income, it's going to be taxed. Your whole life insurance policy doesn't affect that. I assume what he's saying is if you use your whole life insurance policy to do private money lending, there are tax advantages to that, yes. But the way he says it is technically
Yeah.
incorrect. So again, it makes me question how much this guy really actually understands accounting and financial principles.
And this next part at death, the death benefit is included in the estate and taxes may apply. That is true. At the same time, he should also mention the estate tax is now north of 20 million and
Mhm.
that you could just put it into an irrevocable life insurance trust and avoid that and take it outside of the estate. Okay. So
Exactly. He doesn't understand this, right? So the death benefit is included in the state and estate tax is not income tax, right? It's always income tax free, but estate taxes could apply if you're, yeah, as an example, if you were worth more than $20 million. Okay.
married,
Well,
married. Let's be clear.
right, right. But of
You're married.
course, what he ignores is as you mentioned, there's a very, very, very standard, simple strategy to avoid paying estate tax using whole life insurance, right? You take out a whole life insurance policy with a sufficiently large death benefit, and then you move it into an irrevocable trust, thereby removing that death benefit from your taxable estate, right? So he says it's included in the estate, not realizing there's a very simple, easy, accepted strategy for moving it out of your estate with whole life insurance. And that's the whole point. If you wanted to avoid estate tax, right? Okay, so notice how he's also he keeps confusing whole life with infinite banking like they all do. He always ends up conflating these two things. They're kind of talking about whole life, kind of talking about infinite banking and confusing the two. Those are two different things, right? I love both of them, but they are two different things. It's important to keep those distinctions, right, in our mind. So the problem with whole life is it does provide some tax advantage, and his grammar is very bad, but the cost to get that benefit far outweighs the taxes saved. Okay, well, why
As
don't
you
you
say,
quantify that?
compared to what?
Yeah, wait, quantify that. You say the cost to get that benefit. Well, quantify that. So what's the cost and what's the benefit? And what benefit are you talking about? You're talking about just tax savings as if that's the only thing that whole life insurance gives you? is tax savings. It gives you a lot more than that. A lot more than that. If you take out a whole life insurance policy that is what is known as a modified endowment contract, it is now, the gains are now taxable. That is a form of whole life insurance that can be used. And this would still make perfect sense. If whole life insurance, if all of it were 100% taxable, this strategy of infinite banking would still make perfect sense. It would still be amazing. It would not be as good, but it would still be amazing. Because guess what? If you put your money into a savings account, those gains are taxed too, right?
Right.
So it would not be as good. There'd be a missed opportunity where you could have avoided paying taxes, but it would still be amazing. So again,
Right. Because
I guess he's
when you'd pull that money out, Logan, the gain would be taxable at ordinary income levels,
Mhm.
right? But then if you repaid that, you have a cost basis now. Your cost basis just jumped up in that mech. That's what people fail to understand.
Every time you pay a premium in. Yep.
Right.
Mhm.
So if you got 100 and if you put 100,000 into mech and now it's worth 110,000, your cost basis jumped up to 110 if you pull out 10, right? You're going to get taxed on that 10,000, but now your cost basis is at 110. So yeah, you're absolutely right.
So I would say there's, even with a mech, there's still some tax advantages. It's not tax free though. Okay. Do you have any quick tips on lending private money in a tax efficient manner outside of a retirement account? Okay. So again, this is more of a technical question. I would need to do research on this before giving advice. Oh, well, look at that. I would need to do research on this before giving advice. I wish he would follow this more often. Like maybe before you write an article about infinite banking, you should do a little more research on it rather than, I guess, watching one YouTube video on it, which you, I guess, think qualifies you to give authoritative statements on it. Yeah, that's a good idea. Why don't you do research on something before giving advice? Hmm. One thing I will note, please do not fall for the scams like monetized loan sales. Those only work for farmers in a limited sense. Everyone else is not allowed within country mile those things, and there are many more scams out there, so tread cautiously. Okay, fine. But yeah, I wish, Keith, I wish you would do research instead of just giving advice. Great article. Thanks for the info. We do this with a first position HELOC. Okay, cool. Yeah, this is something we covered, right? So he's referring to velocity banking, which was one of the infinite banking alternatives that Keith presented that I agree with. But would do what this guy does, which is take it to its logical conclusion. Don't add a line of credit on top of your mortgage. Replace your mortgage with a first lien HELOC. Our entire mortgage is a HELOC and allows us to pay down the mortgage early without losing control of the money. Very important issue for entrepreneurs. Yeah. So I really like what this guy says, without losing control of the money, right? Again, people, this myopic focus on return on investment plays right into Wall Street's hands. And it ignores much more important intangible benefits like having control. Having control. So I like the fact this guy points out control. And yeah, I agree. Entrepreneurs and real estate investors tend to understand that more than maybe W-2 employees do. It's not about just growing a big pile of money, right? It's also about having control over it. Okay. JT says, although I don't see myself climbing onto the infinite banking train anytime soon, the one concept about this that I can appreciate is being able to borrow against an asset with a stable value and contractually guaranteed rates. When you have a guaranteed return rate of 5% and can consistently borrow at 3% while using it as a storage place for cash when not in use, I can see how it would act as a supercharger to your savings over the long run, even considering the initial drag up front. Now, all the downsides you've named are the reasons that I've never signed up, but I would love to replicate some of the better parts of that with another asset class. HELOCs obviously have some of these same benefits, but the contractual guarantee that you can borrow the money isn't nearly as strong, and the ability to scale it is also fairly limited. So far, this comment is actually pretty intelligent, I have to say. A lot of what he says, I agree with. I'd make some
Well,
nuance, but
only
yeah.
thing I don't like is there shouldn't be the word guaranteed return rate of 5%. I think that we could, because we're factoring in the dividend and everything, right? That's not technically, the dividend's not guaranteed.
Yeah, whenever people throw out numbers, they're pretty much always wrong. So I just kind of ignore the numbers and try to focus on what
Yeah.
the concept behind what they're saying, because their numbers are always going to be wrong, or misused. So
I
yeah.
mean, well, I mean, I'll probably do that, but
But saying that it has a stable value and contractually guaranteed rates, that's accurate. Yeah, with whole
yeah,
life, you're not worried about market
sure.
risk, right? You have a guaranteed rate of return that you're getting, right? And you'll get more than that in almost every case, but it can't go down, it can only go up. Um,
By the way, look at the
and
comment.
also when he's saying when he points out the drawbacks of velocity banking, right? The ability to scale it is fairly limited. That's important, right? So when you're running your money through your home equity line of credit, the amount that that can grow is limited by the value of your house,
Right.
right? Whereas with whole life insurance, that compound interest train is not limited. As long as you're alive, it keeps going up.
Yeah.
Sorry, I think you were going to say something, Peter. I interrupted you.
No, no, I thought that was a good point. But
Okay.
I was just going to say down below, I looked down and I saw this comment below. I kind of jumped ahead, but um,
Okay. And then he says, Treasury Direct also offers some interesting options, but the liquidity isn't quite as simple or free. Yeah, remember he says, your money is always liquid when you buy a treasury. It's
that
like,
that
no.
that was one of the worst comments I've ever heard.
Yeah, it's amazing how many just obvious fallacies. No, when you lend your money to the government, you can't get it right back. You just made a loan to the government and now it's their money. And yet he's complaining about how the cash value supposedly isn't yours, right? But now he's
Right,
recommending that you deliberately give your money to somebody else, the government, right? Make them a
right.
loan. Well, now your money is definitely not yours. You just gave it to the government. At least based on my limited understanding. So this guy maybe has a little bit of humility. That's a good thing.
Yeah.
Any suggestions on other asset classes that you could build a similar option around? Okay. So he didn't respond to this, but this other guy responded saying, you do not earn 5% and borrow at 3% is more like a guaranteed rate of 1 to 2% and borrow at 5%. Well, the numbers are immaterial, but they do kind of change. And it depends on a number of things, depends on policy structure and all that. So I try not to get caught up in numbers because they'll change. And yeah, it depends on a lot of it depends on how you build it, right?
Let's just say it's going to be close to a wash, roughly.
I would
I
say a
would hope.
guaranteed rate of 2 to 4% is what you typically see, and borrow at basically current rates, right? So during the depths of COVID, you could borrow at 4%.
Yeah,
You could
fives.
actually borrow at 3% if you took out a cash value line of credit. Now it's more like 6% because interest rates have gone up. But guess what? The dividends are going to go up too, right? As interest rates go up.
Yeah. Well, we
Okay.
just look at it. I looked at a dividend yesterday, 5.9%, right?
Yeah. And the guaranteed rate isn't all that you get, right? You'll always get more than that because dividends have always been paid for more than 100 years, right? So a guaranteed rate of 2 to 4%, and then on top of that guaranteed rate, you get a dividend, right? Um, and it's funny, I wouldn't necessarily tell people to expect double-digit rates of return in whole life insurance, but it has happened. You can go back and look historically. There were absolutely times when you were earning 12% in your whole life insurance policy. It has happened. Okay.
Yeah. And then, if without going into, we could spend a whole thing talking about loans. Are we talking about a standard fixed loan? Are we talking about a variable loan? Right?
Mhm.
Some
Yeah,
some mutual,
they don't know about all those options.
some of the really good mutuals will let you actually choose when you go to take the money out which option you want to take, and
Right.
that's powerful because you don't
Right.
have to worry when you take out the policy. You don't have to worry about it. You just know that, all right, when I go to take my money out, I'm gonna go have a chat with my advisor and I'm going to determine if I want to take the standard loan or I'm going to take the variable loan.
Yeah, how many banks are going to let you decide what the terms are going
Right.
to be? You know?
Yeah.
And by the way, this is such a pristine asset. You can also take out a cash value line of credit, right? There are lenders that any bank will do it, but there are lenders that specialize in cash value lines of credit because it's such a pristine guaranteed asset. The bank is happy to lend you on very generous terms against your policy. So you could do that too, and that might make sense, right? So you have plenty of options.
Right. I mean, heck, look, the government allows the banks to actually count their cash value life insurance as tier one capital, right?
Yep. Yep. And so now we got back to the original comment. So that's it. That's pretty much it. Not too much there, just kind of an epilogue to what we previously did. Um, there was one, well, I had actually taken a screenshot, I think, of some of the comments I had done, but I don't know where I put it. So, but for what it's worth, I did post a couple of comments. One was kind of, again, clarifying net present value and so on. Another one was saying, hey, we responded to your article and giving links to the videos, to the videos that Peter and I did, to the videos that Chris and I did. And then a third one was offering to discuss it with him. And all three of those comments were either not approved and were never published, or they were published for like a day or two and then removed.
Yeah.
So I don't think this guy is going to be up for the public discussion, but you saw me input into the contact us section offering. If you want to talk to us, we're happy to do it.
Right. Yeah.
So
I think
I
we'll
think
be good.
that's it, Peter. I think, it's the same old tired, ignorant comments, right?
Yeah. So we gotta, I think we gotta do a video. We should, like the top 5 list, right? We'll just run them through them. Won't take long, but we should just run through them, right?
Yeah. Yeah. And they're so easily dismissed, and they're all based on fundamental misconceptions, right? I mean, I'll have to think of the right analogy to demonstrate the level of ignorance required for people to say these things. But it's clear they're just repeating what they've been told. They haven't actually taken the time to investigate it. They just heard Dave Ramsey or somebody else say it, and so they're just repeating it, not ever having taken the time to really understand it. It's like, hey, there's always a flip side to that. You should at least hear the competing argument before you make a conclusion, right? And since you haven't heard the competing argument, right? And really, it's not a competing argument, it's a clarification. It's like, no, that shows me you don't understand how this works. Let me explain to you how it works. And then once you understand that, this supposed objection just falls away because it's just based on a misunderstanding, right?
Right. Absolutely.
Yeah. Okay. Well, thanks for your time, Peter. We'll do this again soon. God bless. Godspeed.
God bless. Godspeed.